Hello, everyone. This is Alex Chausovsky, Senior Business Advisor at ITR Economics, and welcome to another edition of Trends Talk with ITR. Today, we have something very special for you. Anthony Bahr, the Managing Director of Strategex, our partner company, is joining us today to talk about the implications and the considerations that you need to think about as you look to invest for the future growth of your business, particularly through the path of M&A, acquisitions, validations, and things that you really need to be thinking about as you contemplate potential growth through acquisition. So, Anthony, thanks for joining us today.
Yeah, thanks for having me.
So one of the things that we've been talking about a lot as we approach this low point in the business cycle here in the first quarter of 2021 are the opportunities to look out for distressed assets. And part of those distressed assets are companies that might not be able to handle cash flow very well. They don't have a lot of a war chest to depend upon as other more prudent companies do. And so when we think about this, and Strategex has particular expertise in this space, we wanted to really ask, there's a blind spot that many investors potentially miss. And when you think about, in particular, the exposure of a potential acquisition to a concentrated group of customers. Anthony, do you think I can ask you to elaborate on that concept a little bit and really let our listeners know what they should be looking out for?
Yeah, absolutely. And I think customer concentration isn't necessarily a novel thing, right? I mean, we review hundreds of management presentations every year, and in every single one of them, within the first 10 pages, you're bound to see something about customer concentration, right? No single account is more than 5% of revenue, therefore you don't need to be worried about it, right? Our top 10 customers, yeah, they're 80% of revenue, but it's a very diversified group of end industries, so you don't need to worry about it. So it's something that we know is prevalent, right? And in B2B, it really is omnipresent, right? There's really no avoiding customer concentration in the B2B world. It's just a law of nature, right? But I think, you mentioned blind spot. And what I think the blind spot is, and where we see the biggest implication, is not necessarily on the revenue side, which is where a lot of the attention is paid, right? But it's actually on the profitability side. And what I mean by that is, we say customer concentration and we initially think, all right, a handful of customers generate a majority of revenue, right? It's classic 80-20 rule. 20% of your customers generate 80% of your revenue. 20% of your products, services generate 80% of revenue. In your personal life, do you see it? The classic example is in your closet. You probably wear 20% of your clothes 80% of the time. At work, 20% of your employees probably do 80% of the work. So it's that weird anomaly that we see holds true in both personal and professional lives. And in business, and particularly in transactions, it stops at revenue, right? 20% of customers generate 80% of revenue. That's interesting, right? But we would argue that's sort of trivial, right? Very tactical. There is a way to make that a much more strategic implication that has, very, very real ramifications for the transaction itself. But when done well, also unlocks a lot of value creation potential post-close as well. And that's looking at not just the percent of revenue, but the percent of profitability. Because what often ends up happening is, yes, the top 20% of your customer base is 80% of your revenue, but I almost guarantee you it's about 150, 200, sometimes even upwards of 250% of your actual profitability, right? And it's a strange concept. People really have a hard time understanding, how can I have a subset of my customer base generating more than 100% of my profits, right? It just doesn't make sense. That's not how margins work. And it's because, yes, you have a concentrated customer base, which means everything else you're doing, the other 80% of your customer base, is for nothing, right? It's for 20% of your revenue. And I guarantee you it's more than 20% of your time. So we have this bifurcated customer base, and the focus is often paid to the top. But what we often forget is just how much cost and effort it takes to service the bottom and what that means for our op income.
Yeah, Anthony, it's fascinating to hear you talk about that risk on the profit side, because I think many companies don't realize that it exists. And we're constantly telling our customers that, you're in business to make a profit, not just to grow your top line sales. So it's really important to realize that the risk exists. So if customer concentration is a leading cause of deal failure, what can investors do to potentially mitigate this risk?
Yeah, and to your earlier point, there's that great phrase, right? Revenue is vanity, profit is sanity, and cash is king. So you're absolutely right. It is the blind spot. We only think of it in terms of revenue. I don't want to be hyperbolic. Many times we only think about it in terms of revenue, but where it really is a value add is profit. Now, what can we do to mitigate that? Right, knowing that this is omnipresent, as we mentioned, there are a lot of ways to go about it. What we say is that a lot of due diligence out there is focused sort of at the category level, the market level, which is super helpful, especially if you're doing a platform acquisition into a new space. You have to get smart on the industry, right? You have to do your market research. You have to build that subject matter expertise. Now, when we think about valuation models for these target companies, right, a lot of it hinges on their pro forma financials, right? And we know those are not always the most realistic documents, right? They're often quite optimistic. So it's a function of validating what the future looks like, right? That's what we're ultimately trying to do. Is this going to grow at the rate that justifies the multiple? How do you do that? Well, just ask, right? Like it's such a simple answer. It's something that it's elegant in just how simple it is, but go out to those top accounts, right? Those 20% of customers that are critical to retain post close, and just have a conversation with them, right? Understand what the state of the relationship is from a holistic perspective. You don't need to get too detailed. You just need to understand, is this relationship secure? Because if one of those top accounts leaves post close, there is going to be a very material impact on the financials of the business, and it's going to jeopardize the investment thesis, right? If one of them even lowers their spend considerably, it can have the same effect. So going out and objectively, empirically quantifying how strong these relationships are, but then also being opportunistic, right? Forward looking, what do you think spend is going to look like in the next 2 to 3 years, to start calibrating those pro formas and get a better sense of what the valuation actually is.
Terrific insights. Thank you so much. So just to sum it up, I think the key points that we discussed today, number one, you've got to be aware of the potential risk, not just to the top line revenue, but also at the profit level. Understand that you spent a lot of time servicing customers that don't actually contribute to your bottom line. And so when you think about acquiring a business, that definitely needs to be a part of your calculus. The second key takeaway for me was that you've got to have those direct and honest conversations, go out to the potential customers of that acquisition and ask them about what their future spend is likely to look like. Do they have growth plans? Do they have plans to cut back spending? Know before you actually pull the trigger. And, that's going to help a great deal in terms of assessing the real valuation of that particular acquisition target. So we hope you've enjoyed today's session. Thank you so much for joining us. On behalf of myself, Alex Chausovsky of ITR Economics, and Anthony Bahr of Strategex, have a great day, and we'll talk to you again soon.